Hi, everyone. We are on day 3 of our virtual conference. I'm Rachel, the online community manager for the Gypsy Nurse. We are halfway through our conference. We've had a lot of great sessions. If you missed any of these, you can find them on this page or in the article section of thegypsynurse.com. We would like to thank Travel Nurse Across America for sponsoring this conference all week. Be sure to check out their agency profile and their available jobs on thegypsynurse.com. For this session, you will definitely recognize some names, as this company is mentioned all the time in our Travel Nurse Network group. All of you guys have tons and tons of tax questions, so we're going to have Donna from Travel Tracks here to discuss what travel healthcare professionals need to know about taxes while on the road, and particularly tax homes and multi-state issues. Travel Net Tax and the Gypsy Nurse will be giving away $100 travel tax service fees, or $100 off their service fees for the 2020 federal and state returns with travel tax. So you just need to be a travel nurse for that. But we went in together and we're going to give you guys $100 off. So all you got to do is just comment and ask questions and you'll be entered to win. We'll announce that at the end. A little bit more about Donna. She has a degree in business finance with a minor in French from Bob Jones University. In 2018, she joined Travel Tax as the operations manager and has become the tax home and multi-state expert in their office. So she's going to be someone you really want to listen to. So, and we also have Steve here to join us on our first session of the day. So hi, Steve. Hello, Donna.
Hi.
Hi, Donna. Hi, Rachel. Donna, great to have you here today. And as we were talking before this session, this should be a very popular session. As Rachel was alluding to in our Facebook network group discussions and in other areas, the issues of travel nursing and taxes are discussed quite heavily. So you are a welcome guest, and we expect we'll have a lot of great questions and a lot of great activities. So thank you again for joining us, and we hope we can do this again in the future. This is, I think, just the first of many virtual events and conferences that we'll be doing. So thank you for your participation. Before we get started, just relative to this discussion. And relative to the Gypsy Nurse, I just needed to do a little bit of a public service announcement, and that is this to our audience. Please note that the information, views, and opinions represented by Donna Robinson and Travel Tax in this presentation are solely representative of their own organization and do not necessarily represent the advice or opinion of the Gypsy Nurse or its employees. So just had to put that out there, as you guys can appreciate, a little bit of a public service announcement. So with that said, Donna, again, welcome, and please take it away.
Thank you very much, Steve and Rachel. Well, I'm sure there's a lot of questions out there, so I'm just going to hit some highlights about the tax home and about multi-state taxes. And if you have questions, feel free to write those in the chat box, and we'll get to those at the end if you don't mind. I'm going to go over a lot of information and try to do it in a way that I think you would understand it the best. And then at the end, we'll handle some questions. And I see on our Facebook, we had some on the poll, we had some questions and there were quite a few who had tax home. How is a tax home determined? What is a tax home? So hopefully by the time I finish, a lot of these questions will be answered. If they're not, you can feel free to put them in the chat and we'll address them, okay? I do want to say that I just got my braces on a little bit about 6 months ago, and so I'm really struggling with talking with my braces, so just bear with me on that, and I think we'll get through this very well. So on the screen, you can see we have the contact information for Travel Tax. If you have questions and we're not able to answer them today, or if they're really deep tax questions that I would always flip over to one of our preparers, Joe Smith, who's the owner of Travel Tax, who is our guru here about everything tax. If there's too complicated questions, they have to go to him, or if it's international. But we have any of our preparers can answer those questions. So that's our contact information, and we're going to go ahead and get started. Well, if I can get my screen to start. Okay, we're going to talk about tax home. What is a tax home? It's a regular place of business. And by regular place, I'm talking about a geographical area, not a state. If you're familiar with South Carolina, I'm in the Greenville area of South Carolina, but our economic area can go over the border into North Carolina. It can go over the border. Well, really, North Carolina is our closest one to us. So North Carolina and South Carolina, where we are, Hendersonville, North Carolina is still in our economic area because it's a normal commute if somebody wanted to drive to Greenville for a job. That's what we're talking about. Place is the economic geographical area, and business, that's your main area of income. When people call us up and they're saying, Donna, my tax home is here, I have to stop them. I say, okay, let me clarify something. Where were you working where everything is fully taxed prior to you starting to do travel nursing or any kind of travel contract? And that is their tax home, not where they want it to be, but where were they working where everything was fully taxed. That's their economic area of income. If you earn significant money on a regular cyclical annual basis, and we talk about 25% of your annual income, your annual taxable income, and you do that every year, you earn about 25% in the same place, the same economic area before you started traveling, you have a tax home. That is your tax home. And you can maintain it by going back there and working every year and earning about 25% of your annual taxable income. That's one way of maintaining that tax home. What we find, though, not everybody does that. So let me give you a definition of a tax home, a tax residence, okay? I don't usually like to use the word resident, but I will in this instance because some people don't want to go back there and work. So they got to maintain their tax home through duplicating of expenses, and they got to maintain a dwelling, a residence where they're living, where they have their tax home area, okay? So if their tax home area is where they're making their main income, where they have it, that's where they were making it, and they're not going to return there every year to work, then there are stipulations on them. And they have to either maintain the work or they have to have duplicating expenses. That means expenses where they're in their tax home area and at their assignment. They have to have those. And the reason the Congress and IRS and their legal team, they put these restrictions on is because they want to make sure that a normal employee who has housing expenses, who has meal expenses, stuff, that they're not really discriminated against by allowing another person in our citizenship, I guess you would say, have an unfair advantage. So if the IRS is going to give you a tax advantage by allowing you to take tax-free stipends, they got to put the strings on there. So that's why, as we talk about these things, that's why those restrictions or I was going to say another word and my mind just went blank. Limitations. That's a word we use all the time. They do put limitations on you getting that tax-free money. So one way is to maintain your area of work by going back there every year and working and earning at least 25% of your annual taxable income. The other way is to maintain a dwelling there where you have expenses there and you have expenses at the travel assignment. If you do not do either of those two things, you don't maintain it by going back to work every year, or you don't maintain a dwelling where you're living, then you're called itinerant. Itinerant means everything has to be fully taxed when you're traveling. All your stipends have to be fully taxed. We have clients who do that. So that's not a bad thing. If it's too expensive for you to maintain your tax home area, going itinerant is an alternative. And sometimes we do say that's the best alternative for some of our clients. But the majority of them were like, no, it's so easy for you to maintain your tax home. Let's show you how to do it, okay? The other question that keeps coming up with on tax home is, how long can I stay at the assignment and how long must I stay away from it? If you think about it, the tax home can be maintained through returning there on an annual, cyclical, regular basis. So that's your tax home. So if you do that somewhere else, the IRS says, well, which one is the tax home? And then they start giving you, it's like a scale. The IRS has a weighted side and you have a weighted side. If more of the weight is in the IRS's favor to prove that you don't have a tax home, then they will win. Our job is to make sure you have enough weight on your side that you can prove it if you're audited that you do officially have a tax home. So the two rules that or limitations the IRS puts on travelers when you're traveling is, one is you cannot stay in any economic area more than 12 months in a 24-month period. It's not calendar, it's a 24-month period. If you start traveling in July, then July either 12 months before or 12 months after, or going forward, if you just started traveling in a 24-month period, you cannot be in one place more than 12 months. If you are, that switches your tax home to that area. And not only does it switch it there, but for the moment you sign a contract to extend past the 12-month period, from that moment, the IRS expects you to have everything fully taxed at that point, okay? The other question is, well, when can I go back? Well, the IRS says, in this break-in services, you can see on my screen, it says 3 months is not significant. 7 months is somewhat significant, but then we got to look at the length of stay that you were there. But 12 months is definitely significant. That's why travel tax came up with the thing, if you can't be there more than 12 months, and then if you are there 12 months, you got to stay away 12 months. And I've heard people say, oh, if you stay away 30 days, that's good. Not according to the IRS. The IRS says 3 months is not significant. So if 3 months is not significant, 30 days is definitely not significant, okay? Basically, if you're only there 3 months and you go away, you can be in that area for 12 months in a 24-month period. So you can go back as long as your time back there in that 24-month period does not exceed 12 months. And I always tell people try to argue with me on this, and I always tell them, what would you rather be? Would you rather be safe or sorry? Travel tax came up with these restrictions, and we call them our rules for travelers, because Joe Smith, the owner of Travel Tax, he loves reading all of the court cases that come down. All the rulings, all of the legal team from the IRS and the Congress and stuff, when they come out with new rulings and stuff, Joe loves reading those. And he makes sure they come across my desk. So I know he's reading them because I get a ton of them from him all the time. And that's what you need if you're going to be a traveler. You need an expert like that. He stays up with all those rulings and readings. Some of the stuff, it's not like the IRS is ambiguous or anything, but they made the law, and then from that we narrow it down to, well, what does that mean for each individual person's situation? So when we give you a rule here at Travel Tax, it's because of other cases or audits that we have gone through with our clients, and from those audits, we say, well, this didn't pass, but this did pass. So we made the rules. Well, actually, Joe and came up with a lot of these rules of saying what would pass an audit with the IRS. And our job is to make sure that our clients pass an audit if they're audited with the IRS. And I do have people saying, well, what is the chance I'm going to get audited? Or whenever you're in a field where you're getting lots of tax-free money, when things get tight in the government and they need more money, guess where they look? They look for the fields where there's a lot of tax-free money, and how can they get their hands on that tax-free money? If you're doing it right, you're good. But if you're doing it wrong and you're audited, they're going to pin you on it. So that's our job, to keep our clients from getting in trouble with the IRS. Let me show here. One of the things that always comes up is, well, I'm 51 miles away from my home and I'm doing a travel contract. And I'm like, wait a minute, 51 miles does not guarantee that that's a travel assignment. Remember, the IRS wants to make sure that you don't have any more advantage than a regular employee. If 51 miles is a normal commute for every other employee who works in your area, it's a normal commute for you also. So there's no such thing as a 50-mile rule. If you're going to do an assignment and it's too far for you to live at your home and commute, and I tell people, if it's too far for the normal employee to commute, then and you have to get another housing at the assignment, then it would be okay for a travel assignment. But I always tell them, call us and let us see, because on here, I'll give you an example of San Francisco. I've had people call me and say, I live in Concord, California, and they lived in San Francisco, let's say, or they lived in Concord, and now they're going to go over to San Francisco on an assignment. And I would tell them, no, you can't, because Concord is in the San Francisco Bay Area. And I know that specifically because I had a brother-in-law and sister who lived in Concord, and he made that drive into San Francisco every day. Some days it would be a 2-hour drive. Some days it could be longer because of traffic, but it was a normal commute. Same thing at the bottom down there. There's San Mateo. There's San Jose. San Jose, sometimes we can okay that, but most of the time it's still in the San Francisco Bay Area. So if it's a normal commute, if someone who lived there would do the commute, you're too close to call it a travel contract, or it is the same contract. So if someone was working in San Francisco, for example, and they did 6 months there, and then they want to go over to a hospital down in Santa Clara, and they're going to go to a different hospital, in their mind, they're thinking, oh, it's 2 different areas. And my thing is, no, they're both in the same economic area, so it would constitute the same contract. So just want to let you know there's no 50-mile rule. And if you have a question on that, it's always safer to call us and let us just check on it for you. Because when you call, we bring up Google Maps right there, and we look at it, and we do the mileage, and we look at what is the normal commute for that area. Some areas, 50 miles would not be a normal commute because it's up over the mountain. If it's up over the mountain, that changes the whole scenario. So it's always best to double check with us or somebody you trust, okay? Another thing is, I have a lot of travelers who say, well, my tax home is at my parents'. And I always go back and say, okay, where were you working prior to traveling? If you were living with your parents or in that same economic area, it doesn't have to be the same house, but if you were in that same economic area and you decided to go traveling, then you can use your parents' address as your maintaining tax home in that area if the parents' home is in that same economic area. But if it's not, you cannot just choose to use your parents' address, okay? One exception to that is if you just graduated from school and your school was in, let's say, was in Greenville, South Carolina, but you were from Charlotte, North Carolina. When you graduate from school, you can choose your parents' house in Charlotte, North Carolina as your tax home if you're going to go straight into traveling. But if you go and work, you graduated from school in Greenville, South Carolina, and then you decide to go and work in Alabama for 2 years, you can't switch your tax home back to your parents' house just by choosing your parents' house. You would have to go back to your parents' economic area and work there and earn at least 25% of your annual taxable income in that area in order to switch your tax home there, okay? And there are some other exceptions to that, but I want you to know work is what establishes your tax home, not your choice. And again, there are some exceptions on that I'm not going to go through right now, but there are a couple. Care of a family member for a lengthy time, that can switch it. So there are some other options, but to keep it simple, your tax home is where you work prior to traveling. A couple things I do want to point out about if you are going to rent a room from your parents while you're traveling, if it's a related party, a parent, a sibling, a family member, it should look like a normal transaction between two strangers, okay? You can either do renting, where you're renting a room from them, or you can do shared expenses. If you're doing shared expenses, the difference between rent and shared expenses, rent is what is the going rate for a room in that area? Shared expenses is you take the actual expenses of that dwelling and you divide them down to a monthly amount and divide by either the number of bedrooms in the house or the number of adults in the house. You can do either one. Sharing expenses, the one that you're paying doesn't have to claim it as income because you're actually splitting the shared expenses of the dwelling. If it's rent, after they subtract the cost of that dwelling, the expenses of that dwelling from the area that you're renting, that income should be counted as income on their taxes. Again, if you have questions on that, it's better to call us and let us make sure it's correct. Best to write a contract, especially if it's with family. You don't have to, but if you do write a contract, in the contract detailing how you arrived at the amount and stuff. Sharing expenses, I already said there's no claim of income for the one that's you're paying the money to, because it's like you have an apartment and you're sharing the apartment together. You're both paying money toward the cost of the apartment, so that's shared expenses. The one roommate isn't profiting over the other roommate's contributions. The last thing on this says no schemes. Guys, there can be no verbal or written agreement that money you're paying to that relative comes back to you. If they're allowing you to maintain a tax home in their dwelling, that is their money once you pay it to them. There's no, and that isn't the question the IRS would ask you. Okay, is there any agreement that money's coming back to you? Are they paying your school bill for you? Are they paying your car payment for you in exchange for you paying them rent? If there's anything like that, they will nail you on it and expect you to pay taxes on all of that income that you earn tax-free. My little wording I always say, if it looks like a duck, if it quacks like a duck, waddles like a duck, it's a duck. You can say it's a cow if you want to, but the IRS is going to win every day. It's a duck. So make sure those lines are very clear if you're renting from a family member or relative, okay? Common mistakes. I know people who have their house and they're going to go traveling and they want to rent it out. And they want to rent it out 100%. You can't do that, because if you rent it out 100%, you don't have expenses at the tax home area. So you can rent it out partially, and we came up with a plus or minus 29 days. You have to be able to return to that resident at least 30 days a year. If you're maintaining through duplicating expenses, one of the conditions is you have to show that you're returning to that area at least 30 days a year. It does not have to be consecutive, but it does have to be 30 days. And you do have to document that. It's your word against the IRS word. If you have documentation, like if you fly home, you have your airline receipt. But if you drive, I always tell people, buy gas the day you get in town and have that receipt, and the day you leave, have that receipt, okay? So you want to document those 30 days that you go home. The next thing is storage units do not equal a dwelling or a residence, okay? A lot of them have gates on them now. It doesn't mean you are maintaining your tax home area. It just means you have too much stuff. An RV that goes with you on assignment is not maintaining your tax home. An RV, RV slab where you park the RV when you're home, even though you're paying for it while you're gone, you cannot live on that slab without that RV. So taking off in an RV and saying still keeping your slab at home is not maintaining. Now, I did tell somebody, if you bought a cheap RV and put it on some land, and you have the expense of the land, water, electric, and stuff while you're gone, and you have that, even though it's a cheap RV and you want to do that, that is maintaining an area that you can live in it. It cannot be something that you can't live in. It's got to be livable and have water and electric and stuff. And then you can take your nice RV, if you just bought a new RV or something, you can take that one on the road. That would be duplicating expenses. But you can't just have land with no building on it or a slab that you park the RV on. You cannot have that and be considered duplicating expenses, okay? Big question I get a lot, well, what if I've done it all wrong and I don't have a tax home and I've been traveling? Well, if it's the first year that you've started traveling, our easy answer is go back there to your tax home area and work sometime this year, okay? What that is, remember, your tax home area, one way of maintaining is through annual, cyclical, regular work in that area every year, earning at least 25% of your annual income. If you didn't do it right when you started it, go back there and work after the assignment you're on, or if you've already signed for the next one, after that one. Just get back there within that first year and go back there and work and earn that 25% of your annual income, and then start doing it right from that point on. The scenario I use for everybody, if you're maintaining through work, that airplane's going to take off from your tax home area. The same time every year, it's got to land back in that tax home area, okay? When it lands, that's completing that year, and that's maintaining because you're landing back again. If you're maintaining through work, you're going to be back there at least 10 to 13 weeks every year, so you don't have the other limitation of 30 days because you're going to be there 10 to 13 weeks every year in order to earn that 25% of your annual income. If you do not want to maintain a dwelling while you're gone, you have to maintain through work. That's the airplane. It's going to take off from there. It's got to land there, okay? Oh, if you've been doing it wrong for multiple years, call us and let us figure out how we can it's not that we will try to manipulate your facts, but we will look at it from all different points of view. And we do have a think tank here at Travel Tax that will help look at your scenario. And if it's too complicated, we may just have to say, okay, from this point on, do it right and pray you're not audited for the past. But our goal is to get it right for you and to fix what we can. And sometimes pay some back taxes if we have to. So another question that a lot of travelers say, well, why does the staffing agency have to know my business about a tax home? Well, they do have obligations. They give you a tax home statement, and whatever other document they give you is to disclose your tax home status, because they have to do due diligence. They have to have a reasonable belief that the traveler is away from home. That means you're not in a normal commute of your tax home area. They have to have a reasonable belief that you are outside of that area and that you're not working in one area more than 12 months. So in order for them to give you tax-free money, they have to do their due diligence, okay? So it is their concern what you're doing with either tax money, not with tax money, because they don't care what you're doing. But if you're claiming you have a tax home and asking for tax-free stipends, then it is their business to do the due diligence, okay? And we about halfway through our time, so I'm just going to do a couple other things. A normal employee, they were working in one state or maybe crossing over into a second state, but their taxes are very confined to their home state or to an adjoining state. For you travelers, it looks like this. You're all over the United States, okay? So your tax situation is totally different than a normal employee. A normal employee can do TurboTax, they can do H&R Block, they can do the family CPA, okay? As a traveler, you're not normal. And if you do normal, the chance of you getting in trouble at somewhere in the future with an audit is a lot higher than if you went to somebody who understands the tax home situation and multi-state taxes. I'm totally biased because I work with Travel Tax. I think we're the very best, but I'm sure there may be a couple other ones out there. I know there's a few who say they do taxes for travelers, and we clean up their mess every year. So what I'm going to tell you about looking for a tax professional is know that they have experience with lots of states, not just their state and adjoining state. You do have to report all of your earned income, no matter where you earned it from. It all has to be reported to your home state. So if you're from North Carolina, let's say, and you don't work in North Carolina at all for the year, you still have to report and file a North Carolina return because that's your home state. Let me stop right here and talk about home state, permanent address versus tax home. I meant to say that at the very beginning. Tax home is your economic area that you worked fully taxed. Your permanent address is where you have your permanent IDs, your driver's license, your car registration, your voter is where you vote. It's where you get your mail. It's the address that you put on all your important papers, your tax returns, when you buy a car, where you put your permanent address. You buy a home, where you put your permanent addresses. Everything that's permanent is your permanent address. We find it's the best if that permanent address is inside of that tax home area, but it's not always, especially if you're a new grad or let's see, you want to keep your parents' address as your permanent address, but you're working somewhere else. So your tax home is where you're working. Your permanent address is at your parents'. Two different things. it does matter where those two are. And that's one of the first things we have to decide and determine, I should say, not decide because it's already decided, but where is your legal address, your home state, and where's your tax home area? Those are the two key things before we can help you. We have to know, okay? The other one is you pay taxes to your home state if the taxes due to your home state are more than the taxes due to your work state. You will owe taxes to your home state. This comes into play when our clients call us. First thing I do is I bring up the map and say, okay, let's figure out where your tax home area is. Let's figure out where your permanent address is and where you work. And when our clients call and say, hey, Donna, my home permanent address is in North Carolina, but I'm going to go work in Arizona, I immediately give them the difference in the tax between those two states so that they're going to owe North Carolina taxes if Arizona's taxes are less than North Carolina. And I don't have time to look over there and see exactly. I have it all on my wall here beside me to let them know the difference between those two states tax-wise and which states have peculiarities that you need to know about. If you're a resident of Illinois and you are working in different states, Illinois doesn't accept that double reporting. So a lot of times we have to get a letter from the staffing company saying where they earn their income, and we have to send that to Illinois because Illinois requesting it all the time. New York State, they have a rule that if you live there more than 183 days a year and you maintain a resident or have access to a residence, even though you're gone, you are a resident of New York. So knowing all these rules about these different states, if your home state is unfortunately Ohio or Pennsylvania, and you work in a state that doesn't have a local income tax, I'm going to tell you right up front, well, just remember to be putting money aside to pay the local tax of your home state because your work state won't deduct that local tax and you will owe the local tax to your home state. The employer's main responsibility, your staffing company's responsibility is to deduct for the work state. If you are going to work in a state that does not have an income tax, Texas, Tennessee, Florida, Washington State, there's a whole list of them. But if you're going to go work in one of those states, you really need to ask the staffing company if they can deduct for your home state, or you need to be doing quarterly estimates and putting that money aside because you will owe that money to your home state because you don't have offsetting credits to come against what you owe the home state. The big question is, people say, am I being double taxed? No, you're not being double taxed. Taxes paid to a non-resident state are allowed as a credit against their home state. That's why if you go to a state that doesn't have income tax and your home state does, that's why I tell you got to put money aside to pay those income taxes to the home state because you will not have that credit to go against that. If the work state's taxes are higher than your home state, you're going to pay those because they're automatically going to take those out. But if your home state's taxes are higher than the work state, you're going to owe the taxes that you paid to the work state, and you're also going to owe the taxes to your home state. Sorry. I'm going to skip through this part right here because it's really not the best thing for this. I will bring up this. Certain states have a reciprocity agreement. The reciprocity means that, let's say Virginia is your home state, and you went over and worked in Maryland. Well, Virginia is saying that you don't deduct taxes for Maryland because the reciprocity state, you just deduct for Virginia. Maryland won't charge you taxes on that money because they have a reciprocity agreement with Virginia. There's also reverse credit for states that have, it's a reverse reciprocity agreement, California, Arizona, Oregon, Indiana, and Virginia. If you're from Virginia and you work in Arizona, Virginia, okay, my mind's going, I'm getting, how's the best way to explain this? Just know there's different states. Some states have reciprocity agreements. Some places have reverse reciprocity agreements, and your tax preparer has to know that. If they don't regularly work with those states, they won't realize that unless they do the due diligence, and we find that they don't always do that. They end up putting you as part-time, part-year residents in those states when you were never a resident in those states. So just be aware of that. Back to the multi-state professional versus a one-job employee. We have people call us all the time. They're sitting there on TurboTax on their computer, and TurboTax will not allow them to do what they are trying to do on it. But TurboTax is not made for a complicated tax return. Neither is H&R Block. One of our preparers was from H&R Block way back, and she's one of the best of the best, but she had no idea about tax home situations until she learned that with us. And even though she knew taxes very well, and H&R Block knows their taxes, they do not understand tax home issues and how to deal with all the different multiple states on one return or one preparer. So I just want you to say is if they're not asking you the right question, if they're not asking you about your tax home, they're not asking you for copies of your contracts, if they're not asking you the questions, they may not know that they need to ask you those questions. So if they're not asking those questions, they may not be the best one to do your return for you. So just be aware of that. In our office, when we're looking at things, this is a map in our office, and we're constantly looking at that map and seeing how each state you're going to, how they interact with each other. We have our little notes on there, and in each office, we have individual notes on each of the states. So just be aware of that. There's a lot more to the multi-state taxes than just what the normal CPA has prepared in the past, okay? And that's the end of my presentation there. We did have a couple of questions, so I want to make sure I did answer for you. Your tax home is determined about where you worked prior to traveling. And I gotta finish this up because I want to give a little bit of time for Rachel to ask any other questions. Your tax home is your economic area where you earn significant money on an annual regular basis, or that you maintain a dwelling that you duplicate expenses both at the tax home area and at the assignment. And one of the questions that came in is, how do I know I'm picking the right tax professional? If they're not asking you the right questions, they may not be the right company for the job to do your taxes. Buying a house where the travel assignment is located, but after contract has ended. Okay, we have this multiple times with clients and stuff, is they're going to be in a tax home area and they want to buy a house there. Well, remember, you cannot live there more than 12 months in a 24-month period without it switching your tax home there. So if you're going to buy a house where you're doing an assignment and then you're going to rent it out or whatever you're going to do, remember, it's more important that you protect that tax home area, because that tax home area is where you need to go back and work on a regular basis or maintain a dwelling there that you're doing duplicating expenses. And with those two lines start blurring, the IRS will have an argument to say, they're going to look at where are you making the most money. If you're not maintaining through work in your tax home area and you're maintaining a dwelling in the area where you're doing your travel assignment, you're opening more questions for the IRS. So just be aware of that. You can buy it. Now, for example, New York. Remember New York's rule, if you're there more than 183 days and you have a dwelling there, even if you're doing a temporary assignment, if you're in New York or have access to a dwelling there more than 183 days a year, they consider you a resident of New York, and they will go after your money that you made, no matter where you made it, if you're a resident of, if you have a home in New York. So just be aware of that. What if I'm working out of the country for a period of time during the year? That's a question that you really need to call travel tax and ask that question. A good portion of our business is international travelers and international clients. So be aware, just call that, because every person's scenario is different. And the last thing I want to just make one more statement is, guys, just because another traveler is doing something does not mean it's right, okay? It's like, I don't even have an example right now. It's somebody who says, well, I'm doing it this way. Well, he's doing it. Why can't I do it? When at the end of the day, the IRS doesn't care what somebody else is doing. They care that you're doing it right. And even the staffing companies, it's not their responsibility to know the rules for you. Their responsibility is they have to ask you if you have a legitimate tax home. You fill out that form that relieves them of their responsibility, their due diligence. You are responsible for doing it right yourself. So call travel tax, and we would go through your individual scenario to see if you're doing it correctly. Travel tax was founded by Joe Smith and his wife, Dinah. And they were both travelers, okay? Joe was a respiratory therapist and Dinah was a nurse, traveling respiratory therapist and traveling nurse. And so their heart is with the travelers. So Joe would just happen to be an accounting major who his fellow travelers were having him do his taxes. So it started off with just a little bit and became a big business, and we're growing leaps and bounds every year. And they've been in business 20 some years. So just be aware that travel tax understands what you're going through out there. And our heart is to hold the hands of our clients and our travelers. So Rachel, that's all that I really have to say. I'm going to turn it back over to you if you have any questions.
I know there's some comments that came through there.
So maybe they just didn't come through on my side.
All right, I'll ask them and then you can respond. So
Okay.
we have Sierra. She said, what if you go from a travel assignment to a seasonal assignment through the hospital? Does the time frame stay the same or no? Because seasonal, you don't get any tax-free stipends.
Okay, when you're not getting tax-free stipends, you're just like a regular employee. So if you want to continue to travel after that seasonal assignment with them, you still have to maintain your tax home area. So if you're going to, let's say you were there for 3 months as a traveler and you want to stay on for a seasonal thing for 3 more months, you got to be careful that you're not making more money in that area fully taxed than you did at your tax home area. But that is probably a question that I would rather ask her more questions about, to find out how long she's going to be there, what are her intentions. The IRS looks at intentions just as much as what are you doing right now. And if they see a pattern that you intended to stay over your 12 months, then the moment you made your intention clear by signing a contract or really signing that contract, they go from that point, not from the point that you went over 12 months, but from the point that you signed your intentions of staying over. So I really would need to ask her a few more questions about seasonal work. Remember, seasonal work, maintaining your tax home through work is returning on a regular annual cyclical cycle. seasonal. I'm seasonally going back to my tax home and working every year. So if you're doing the same thing in another area, then it's the question, which one are you making more money at? So there's a lot of questions I would have to ask on that, okay?
Yeah, and then we have Megan. She says, I pay monthly bills to cover my tax home rent, but the bills are not in my name. How can I make proof of regular tax home payments?
Okay. First of all, she's using the word rent. So
Yep, she put rent.
yeah. So when I always question that, because if there's a 2-bedroom apartment and she's doing one and somebody else doing the other, they really should be splitting the expenses of their apartment down the middle, and that's not rent. That's sharing expenses of that apartment. If they have a room in somebody's house that they're renting out that room, if it's they can either classify it as rent, and that person has to, on their taxes, declare it as rent minus their expenses for that room and stuff, of course. Or they can use shared expenses depending. And I tell this to travelers all the time, if their parents' house is paid off and all they have is their taxes on the dwelling, their insurance on the dwelling, and utilities, sometimes it's really cheap to do shared expenses on that dwelling. You divide the monthly amounts by the number of rooms in the house or number of adults. Does that answer that?
I think so. And then we have Allison. She says, this is kind of around the same way. If you share your tax home with parents and decide to take a couple months off from work during those couple months, do you still need to be paying into the tax home?
This is my thing. What are you planning to do after those couple months? Are you going back to traveling, or are you going to stop and get a regular job that you're not going to be traveling anymore? So this, again, that's not an easy question. My thing is, if you're going to continue to travel, you continue to pay your rent.
All right. And then Megan has another question. She also said, thank you for explaining shared expenses. And she also asked, what are the best documents to keep? I heard the receipts on arrival and leaving, but do I need to keep every receipt for the year?
Okay. First of all, you need to have documentation that you're paying what you're paying, okay? So if you're doing shared expenses, you want to have it documented how you arrived at the shared expenses. You want to take, if it's a home and the home's paid off, it's easy. You just take the taxes on the property for the year, divide it to a monthly amount, the insurance on the property for the year and divided by a monthly amount, and the utilities, and just the main utilities, electric, water, gas, and get a monthly amount and divide those things by the number of bedrooms in the house or the number of adults. If you want to, sometimes it makes sense to do one or the other on those two things, and that's your amount, and you document that in your tax folder that you have for that year. And I always recommend you have a folder, because you will not remember where you put those receipts and stuff if you don't have that. Bank statements work. If you pay by check, you don't have to keep a copy of the check. You have your bank statement. But I would print off the bank statement and put it in that folder, or save it on your computer or something, so that you have proof of the amount that you paid every month on a regular basis. Is that any other questions on that, Rachel? Does that answer that?
I think so. And then I thought about it too. Is there any good like apps? I know there's a lot of apps like there. I know like Intuit, like QuickBooks have apps for like to keep track of your receipts. Do you guys have any recommendations on really good like receipt? Because I know a lot of people don't want to carry around a lot of things. So like any apps or websites that really help with keeping track of those things?
Well, I'm totally biased. I like Cam Scanner, because I scan in receipts and you put it in a folder and you have it. But that's me. That's what I like to do for receipts. I don't really have one to recommend for tracking receipts on your phone or something, except for scanning, and I use Cam Scanner for that. So somebody else may have a better answer for that. I don't have that one.
Gotcha. That's all right. Well, I think that's all the questions. If anyone has any last minute ones, hurry up and put them in. If not, we're going to go ahead and end the session. Thank you so much, Donna, for coming on. A lot of great information. We always appreciate all of your guys' help and all of that. So.
Well, thank you guys for including travel tax in your presentations. And
Oh, no problem. Oh, we have one more pop in.
okay.
She says, Amy, she says, I have a permanent address that I pay money and split utilities with a parent at my home base. I work as a PRN position at the local hospital when I'm home. Is there anything else to maintain tax home while traveling?
No. I have a lot of clients that do a PRN job at the tax home area, and if the amount that they're making in that for the year is more than 25% of their income, then that alone can qualify that as maintaining their tax home. Is just working that job, going back there, and the repetition of going back. Remember, if you're going back there to work, if you're earning 25% of your income in that area every year, the IRS said that's a hardship, because when you go back, you do have to find housing, okay? You do have to have a place to live when you go back each time. So be aware that if that PRN job is earning you 25% of your taxable income, and as a traveler, your taxable income is lower, because you have all these tax-free stipends. So that 25% could be a lower amount than normal, because it's off 25% of your taxable income. So that's a good question to call. And let me look at some numbers with you to make sure that yours is meeting that criteria. And then you wouldn't even have to maintain the rent while you're gone if you're earning 25% in your tax home every year.
Yeah, she says she goes home between each contract.
Is this her first year traveling, or has she been traveling for multiple years?
Let's see. Waiting for her response.
And the reason I asked that is because if she traveled last year and she's traveling this year, she'll have an idea what her annual salary was, her annual taxable income. And if what she earned at that PRN job is 25% of that, that PRN job is enough to anchor her in her tax home. If it's not, I'm just going to give some numbers. She's making $50,000 for the year, and she's only earning, $5,000 in her tax home. Then that's not going to be enough of an anchor. She would have to be paying rent there. Paying rent or shared expenses does not negate her being able to go home and work. But the time she is home, she can count that as her 30 days. But if she's earning at least 25% of her annual income, taxable income in her tax home, then she doesn't have to worry about paying the rent and how much she's paying. That brought up another question is, people say, well, if I'm on assignment and I'm living with a relative, I'm doing an assignment in an area where my relatives live, do I have to pay them, or how do I have to calculate the rent the same as I do in my tax home area? You don't. The IRS doesn't care about the amount at the travel assignment. They just care that you are paying something. So if you can live on the cheap, if you're given $1,000 a month housing stipend, and you can live and find a place for $500, great, that's wonderful. The IRS isn't concerned that you're not using all the money at the travel assignment. They're concerned about what you're doing at your tax home. Okay.
Gotcha. Well, that was good stuff. We appreciate it. And if anyone has any other questions, feel free to just ask them below. I'll forward them over to Donna over at Travel Tax. But thank you so much again. And hopefully we can have you on again to answer some more questions.
Sounds good. We've got a great team here. So, and again, I'm highly biased. I think my team is the best. And Joe, I think he's the guru of tax. So we bow down to his knowledge because he's the So but I'm biased.
Well, thank you so much. Bye, everybody.
Thank you, Steve. Bye-bye.